You're watching Market Guru, and today's Market Guru is Ajay Bodke. He's the CEO and Chief Portfolio Manager at Prabhudas Lilladher. Ajay, always a pleasure to speak to you. Thanks very much for taking the time to join us. I wanted to start out, Ajay, with the capital cycle, and we may be still away 20 to maybe 15 to 20% from full utilization of capacities across industries. But usually markets try to figure out when that capacity could be fully utilized, and we start to pick up on the next capital consumption cycle. How far away are we, Ajay? Because if that's the case, market as a leading indicator could actually give the signal much ahead, and then we could have 30-40% on the index before the capital cycle kicks in.
Good morning, Ashu. I think I would delineate the entire CapEx program into two distinct baskets. The first is the infrastructure basket and the other is industrial basket. The basket that you are referring to essentially is the industrial basket. The fact of the matter is that India needs a lot of infrastructure investments in sectors like roads, railways, power transmission, airports and ports. And that is where the first flush of investments are happening, albeit it's happening from the government side. The government is kickstarting a massive public investment program in roads and railways since last year. Roughly 2 lakh crores they did pump in last year, and they are budgeted around 2 lakh crores again to be pumped in these two sectors this year. The multiplier impact of that, as per the economic survey, is roughly 5 to 7-fold over the medium term. So I think it will take a few quarters, I think, after the tendering happens for that to reflect into the aggregate demand on ground and the bump that one gets in terms of push for the downstream sectors. Now coming to the industrial side, I think that's where the capacity utilization of sectors like steel, cement, other metals, manufacturing, parts of manufacturing is hovering between 70 and 75%. And in my opinion, it will be a goodish 1 to 1.5 years after revival of consumption-led demand, which will be the front-loading demand for those capacities to be utilized, and then private sector thinking of putting in capacities in sectors like cement, other metals, or manufacturing. So I think I would in terms of portfolio construct, I would first be looking at focusing on consumption-led sectors where we'll be overweight. Then some of the infrastructure-led sectors I will look at, and finally I'll allocate to the industrial capex-led sectors. So this is the chronology in which I'll position myself. In addition to that, of course, some of the generic pharma names I'll continue to bet on, because whatever be the ideological strain that is in ascendance in the West, be it America or Europe, be it left or right, I think both of them are focused on bringing down the healthcare costs in the developed world, and that's where the Indian generic manufacturing industry comes in, which basically has a lion's share out there, and it will continue to push in a large amount of generic products, which will be a win-win for both the developed markets as well as the Indian manufacturing.
Okay. So, I know that you're saying that focus on consumption first at this point, Ajay, but let's just take a look. For instance, let's take a look at some of the auto names, and we've seen that great run up. I mean, how would you position a strategy there, given that we've seen a run up, but we're not really seeing it sustain beyond a point? Is that a valuation concern? Is it genuinely a demand concern? When do you see the picture truly kind of turning around and staying that way?
Yeah, I think auto is, as you said, right example to start with. We've seen that the auto stocks have moved up fairly over the last year or so. September quarter numbers, in my opinion, will continue to be more or less in line with what we saw in the June quarter numbers. So the real upturn in demand, I'm estimating, should start happening from October onwards, because that's when the festival season, both Diwali and Dussehra, falls, and the harvest should come into the market in end of October, early November. That should help in terms of bumping up the demand on the rural side. So I think December is the quarter that the equity market being forward-looking are focusing on. They might even ignore the trends in the September quarter, provided the commentary that companies, the September quarter numbers clearly holds out the prospect of an improvement in the second half numbers starting from the December quarter onwards. So I think markets will be patient even if September numbers do not live up to the expectations of market participants, because they'll be focusing again solely on the December and March numbers. I think in that context, I think one clearly is seeing the analysts upgrading the target prices. Let's take the example of Maruti. I think just 6 months back on the street, the target price that analysts had for Maruti was between 4,000 and 4,500. But then as some of the key drivers became evident, namely the 7th pay commission related improvement in urban-led demand, or the good monsoons expected to play into the rural-led demand, plus the fact that Maruti, despite having volume constraint, is moving up the value curve in terms of more value-added cars being sold, like Baleno or Brezza. So I think, and hence the margin profile improving, and the fact that sort of from next January onwards the new plant in Gujarat should come on stream. So that has made the market take note and upgrade the target prices between 6,000 and 6,500 levels. So I think you will continue to see a similar upgrade in terms of target prices for companies in consumption-led sectors, so based on the improvement in the volumes and the pricing power that should also come back, a combination of the two.
Ajay, my concern is not so much how much the economy is going or how much the companies are doing well, but my concern is what do I make out of it? And so if I consider the economy a well and the lever and the bucket that pulls the money out the company, I need to know if I can drink the water. The problem with a lot of these companies are, or what you're saying about the economy, is that as a shareholder, I'm not getting anything. I mean, I'm just depending on capital appreciation. For that, I need the stock markets. I don't need the company to tell me what's going on. If the stock markets go up and I'm a smart trader, I can still make money. Could you tell me, Ajay, where are the companies, in which sectors, where I can expect them to at least share something with me in terms of corporate governance? Because that in India is a very, very big issue. We just saw a $13 billion deal go through, and I'm sure the shareholders got nothing out of it because the company got delisted 6-7 months ago.
I would respectfully disagree there, because I think the regulatory environment in India has changed for the better in favor of consumers and shareholders. And after the delisting happened in SR Oil, I think the company had approached SEBI, and both the regulator and the company had agreed that whenever the deal goes through in terms of the promoters selling off their stake to a prospective buyer, whatever is the equity valuation per share that the promoters would get, the same would be given to the minority shareholders within 1 year of completion of that deal. So I think one is clearly seeing an evolution vis-a-vis what it was, say, 5 or 10 years back, insofar as the Indian capital markets are concerned, and the levels of transparency and corporate governance are immensely better than sort of what they were over the last few decades. And this deal is a testament to that.
So, for example, Citi actually is saying that on the post the SR deal, the effect will be spread out on ICICI, SBI, Axis, and they've also said the best placed debt is in the offshore holding company, which will get the proceeds of the sale, as we know, and the allocations unlikely to be straightforward, predictable, or necessarily proportionate, but they are seeing early stages of the recovery cycle, and the transaction does make it more visible, the fact that the recovery cycle has also started to, of course, turn around. Would you agree, Ajay?
Yes, I think, you just look at last 2 months and the kind of massive FDI flows that India has got. I do not recollect in my memory over the last 20 years that in a short span of 2 months, one had got such a large inflow. We have a $13.5 billion coming from the SR Oil and the Vadina refinery deal. You have the ARCOM selling tower assets and getting $1.7 billion from Brookfield. And let's not forget that Vodafone, I think, also had pumped in roughly between, I think, $4 or $5 billion. That number eludes me, as an equity infusion in its business, which also would be used to delever its balance sheet, and the money would come to Indian banks. So I think from the Indian banking perspective, especially corporate focused banks, the last 2 months, if that were to be taken as indication, then I think, more monetization of such deals were to happen, then I think one can finally start seeing the light at the end of the tunnel. Although I'm saying one will still have to wait for a quarter or two, but I think the beginning is quite propitious insofar as large FDI inflows in the country is concerned. And here again, one must give the due to the central government for putting in place policies that are making foreign investors looking forward to India as an attractive destination. Right. And insofar as SR Oil is concerned, I think roughly $4.5 billion would be used to repay the SR Global lenders. Standard Chartered, I think, is one of the biggest beneficiaries, along with ICICI Bank and Axis Bank. And out of 88,000 crores of total debt that the SR entities carry, roughly 44,000 crores will be repaid as per Mr. Prashant Ruya. So I think we have a 75,000 crores of relief that the banking system as a whole has got in India, as well as sort of, as I said, $4.5 billion goes to foreign banks, rather foreign banks, Standard Chartered and ICICI Bank, SR Global debt holders.
All right, Ajay, so obviously the Reserve Bank of India has some wrong data because according to their October 15th data, their foreign exchange reserves have fallen by $4 billion over just 1 week. So if we are saying $20 billion has come into India, then obviously the RBI has it wrong. Now the government claims that $60 billion has come in, but India's foreign exchange reserves have not even risen by $7 billion in a year. Could you just explain the dichotomy to me? Either the money is going back out again, or either the RBI data is incorrect, because we seem to say that all this money is coming in. So where is it going?
There is no dichotomy. No. Yeah, there is no dichotomy out here. There is always a time lag between the announcement by a company, by a foreign company, in terms of committing certain FDI investment and the money flowing into the country. For instance, I think the Reliance communication deal was signed just a week back. Now it will be it's impossible for that money to flow into immediately and to get reflected into RBI data instantaneously. I think as long as the MOU stands and Brookfield is committed in putting in that $1.7 billion of money, over time, maybe it might take a quarter or so, that money will get reflected. Similarly, in case of SR Global, we got Rosneft, we have to wait because the deal was just signed yesterday. 13.9 billion would come as an FDI, but it will again take time for it to come in. It will not reflect in the next week's RBI data or possibly even next month's RBI data, but it could be possibly a quarter from now.
Okay. Fair enough. Ajay, so let's just understand and I know you sort of started off with talking about perhaps where the opportunities could be, but what would you say is a clear overweight right now? What are you clearly avoiding?
Yeah, I think I'm looking at retail-focused private banks. IndusInd Bank and HDFC Bank are the ones which form the core of our allocation in BFSI sector. In corporate focused banks, I believe that Yes Bank, after the correction that it has seen post the QIP being called off, clearly allows investors an opportunity to look at the company with a medium-term perspective. Mid-cap pharmaceutical is an opportunity that we are very positive on, and there I think we are primarily betting on three franchises rather, Glenmark Pharma, where we are expecting an approval for a blockbuster cholesterol lowering drug Zetia to come through in December. The proceeds from that will be used to right size the balance sheet, and we expect the stock to be re-rated in the medium term. Aurobindo Pharma, a large number of approvals are pending from US FDA over the next 12 to 24 months. We expect sort of a quickening of pace for those approvals in Aurobindo Pharma's case. And the third franchise which we like but which has already moved up quite sharply and hence will advocate buying into it on dips is Jubilant Life Sciences, where they have a very strong hold in radiopharmaceuticals, one of the few Indian companies having a presence in radiopharmaceuticals business. And they also have got a very large approval for Rubifil. And we expect over the next 12 to 24 months, 4 or 5 more such approvals are in the offing for the company. Mid-cap cement is another space which we like, and there Heidelberg, I think, is our preferred bet. The stock in terms of EV per ton basis is a significant discount to not only the large cap names but also some of the other mid cap names. The company has a fine pedigree, owned by Heidelberg, Germany, very well managed. EBITDA per ton should start looking up, and hence I think that is one space that mid cap cement is what we like.
Right. Ajay, I wanted to go on to cost of capital, but again, I just wanted to share something that maybe I'm missing in the data. I went back to the beginning of 2016, and India's foreign exchange reserves were 350 billion. Today, they stand at 367 billion. That's an addition of 17 billion US. Now, till June 2016, India had already received 44 billion in FDI. And we are in October, so I'd calculate that we have received at least 60 billion in FDI, and I'm just taking a rough number that we received another 10 billion in FII. So that's about 70 billion. That should have taken our reserves to 420 billion. Again, I'm not able to figure out, because there seems to be an equal outflow then, but when I look at the export data, India's exports are falling. So how is it that $70 billion of money came in, but the Reserve Bank only shows an incremental increase of $17 billion in its reserves, when even our exports are not rising? So how are these outflows going out, and where are they going?
I think, one will have to look at in granularity this particular data. I don't have an answer right now. But I think the FI number that you are mentioning, is it only equity number that you're looking at, or also debt? Because on the debt side, I think, the last year there could have been some outflows out there. So unless it's a combined data, I don't have an answer right now.
Ajay, what about IT? What did you make of the numbers? And actually, more than that, since we're kind of expecting a slow quarter, what do you make of the guidance and the commentary? Do you think it's over bearish? Would you sort of be averse to looking at IT right now?
I think there have been some analysts who have started writing obituaries for the Indian IT sector. I think one need not be so despondent, because one has seen, let's take Infosys' case. I think, the company's second quarter numbers did beat the street expectations. However, what took markets by surprise is the fact that they cut their guidance a tad bit more than what the market was expecting them to do. But I think, the companies, both the TCS and Infosys, have adopted, in my opinion, a very cautious stance. In Infosys' case, twice bitten, so sort of, they want sort of, don't want a repeat of what happened in the first 2 quarters in terms of cutting the guidance. So almost all the headwinds that they might encounter, I think, in my opinion, they have already factored in, and they have left some room for an upside surprise going forward. The environment continues to remain challenging, in my view, and I would sort of be underweight in IT sector. Although I must say that the valuations do look at sort of at the rock bottom level, but then the accompanying earning growth also is quite tepid. So on the whole, I would be underweight and wait for sort of some signs of a large scale move from these behemoths into the newer technologies. One clearly is seeing some movement out there in terms of artificial intelligence or automation, digital technologies, blockchain. But I think it will be foolhardy to expect that a large companies like Infosys and TCS or HCL Tech would overnight be able to move a large chunk of their revenues away from the legacy revenue streams to the new age revenue streams, where the demand is higher, the margins are higher. At the same time, the HR skill sets required also are significantly different out there. So I think I would much rather look at certain franchises which possibly could be smaller in size, but which specialize in these mobile and digital technologies, and where there is a scope in the medium term for better capital appreciation.
Right. Ajay, I just wanted to shift a little bit to the consumer industries. And I was looking at the Nifty Consumer Index. Now, that's up only 9% this year. Could you share with us why this buoyancy in the consumer sector in the economy is not showing up in the Nifty Consumer Index?
Yeah, I think if you just go back and see the sharp jump in the commodity and some of the agri-commodity prices, you look at sugar, you look at wheat, you look at palm oil, I think one has seen from the absolute multi-year lows that one saw, say, a year back, a sharp upturn from those levels. And hence, what the analyst community feels is that the peak gross margins that some of these companies were able to show, I think we may well be behind those margins, and that's why we also saw crude moving up from the absolute lows that we saw last year, impacting the crude derivatives that also form the inputs in certain consumer companies. So combination of agri and industrial commodities moving up is starting to impact on the gross margins for some of the FMCG names, and that is why the apprehension in terms of further re-rating for these stocks, which already are priced quite high, is holding back further appreciation in these names. And as I said, till September, one is not clearly seeing a visible improvement in demand. Like if you saw the commentary that Unilever gave, insofar as India is concerned in its just announced results, they are basically mentioning that the increase in the input costs is clearly hurting the Indian franchise. And one is seeing similar commentary from some of the other companies also. So I think the key to watch is the improvement in volume growth in December quarter and March quarter, and the pricing power coming back to these companies in those quarters. Only then the valuations that the lofty valuations that the market has afforded some of the franchises can sustain.
All right. Ajay, we'll leave it there this morning. Thanks so much for joining us and taking us through some of your views as they stand currently.